Hello, and welcome to our Builder of Choice Insights podcast. So excited to have you joining me today. We have an amazing lineup today, and I'm going to introduce our guests in just a moment. But today we're going to be talking about the economic outlook for the remainder of this year and into 2026, and all of the things that you need to know as a home builder today. But before I introduce my guests, I do want to share a quick message from our sponsor, Cornerstone. They've been an amazing partner for us for a long time here at the Shin Group and are helping to make this podcast possible for us today. So with that, I'll go ahead and share their message and we'll be back in just a moment.
Cornerstone is a family and team member owned company. Over the past 4 decades, we've worked tirelessly to earn the trust of our homebuilder partners and referral sources. Cornerstone's partnership models are designed to fit each builder where they are today, with dynamic, collaborative solutions that support growth, closing certainty, and profitability for tomorrow.
Our decades of experience, dedicated team members, robust infrastructure, and unique portfolio and niche financing options are what propelled Cornerstone to be the industry leader in the home builder partnership space.
At Cornerstone, builders trust us to make financing solutions simple for their customers and to increase pull-through. Have a unique borrower? No problem. We specialize in solutions for everyone from self-employed clients to I-10 and foreign national borrowers. We are built to support the way your success is intended every step of the way.
We understand the art of supporting home builders so you can focus on what you do best, building wonderful homes and delivering exceptional experiences to your home buyers.
In addition to being a national mortgage lender, we're a bank with unmatched stability. Cornerstone has 3.5 times the amount of capital required to be deemed well capitalized. We have more than 100 builder relationships nationwide. And with our suite of solutions, including preferred lending relationships, mortgage banker joint ventures, mortgage broker joint ventures, and advisory services, we tailor our approach to help builders qualify more customers and sell more homes.
At Cornerstone, we don't just help our builder partners stay in the game, we help them win. We're all about driving your growth, delighting our customers, and boosting your bottom line. Like you, we're entrepreneurs and we make bold decisions. Let us talk to you about how we can bring the power of Cornerstone to help you build as you build for others.
Well, thank you so much, Cornerstone, for being an amazing partner and really believing in our mission to continue to help builders be the best builders in their market, being that builder of choice. And with that, I'm going to go ahead and introduce our guests. We have Danushka with us today. She's the Assistant Vice President for Forecasting and Analysis at the NAHB. We have Dan Habib. He's the Chief Revenue Officer at MBS Highway. Mark Vittner, with 30 years of experience at Wells Fargo as the Managing Director and Senior Economist, who's recently gone off on his own and founded Piedmont Crescent Capital. We have Alex Thomas from John Burns. He's part of the macro team and tracks national economic and housing trends. And of course, the one and only Chuck Shin to bring his perspective on how the economy will be impacting your businesses. We all know that Chuck doesn't hold barred, so he will be sure to share his opinion. And we have some great minds today to be able to tell us what to expect from the decisions made from the Fed and how that's going to impact our businesses. So with that, I have a question to kick it off, and whoever would like to start, but I'd like to hear a little bit from everybody. Yesterday, the Fed met, and we know that they dropped the rates by 1/4 point. Can you guys share a little bit about what the key factors are that the Fed takes into consideration when determining the movement of the federal funds rate and how these elements impact the Fed's decision? And does one weigh more than another?
Well, tell you what, it would be my honor with this esteemed panel to kind of kick it off and give my thoughts, if that's okay with everyone. And to the audience, it's truly an honor to be with you guys. But the Fed has what's called a dual mandate, which means that the two things that they are mostly concerned with when determining their monetary policy, what they do with the Fed funds rate, is stable prices, which means that they want to see inflation minus food and energy prices. It's called core inflation at 2%, and they want to see maximum employment, which means that they want to see the unemployment rate low. Now, the Fed is focused on both of these things, and for a while they've been more focused on inflation. But now the unemployment rate's starting to creep up, job creations are slowing, and there's a higher risk there in their opinion that things could get a little ugly in the labor market. And that's really the reason why they went from pausing to cutting rates yesterday. Now, it's important to note, the Fed is not cutting mortgage rates. You probably have a ton of customers out there. They see the Fed cut, and that means they think mortgage rates drop 0.25%. Short-term rates are directly impacted. Money market accounts, short-term treasuries, things that are important to you guys also have get influenced, like construction and land loans and things like that. But there's more of an indirect relationship with longer-term rates because, after all, the Fed funds rate is an overnight rate that banks use to lend to one another. So it's very short-term. And a lot of people, they look to last year and they said, well, the Fed cut 1% and mortgage rates went the other way. But they forget that, listen, the markets are forward-looking. And before the Fed cut last year on September 18th by 50 basis points, mortgage rates came down by 0.5% to maybe 0.75%. And then they were stable. And then we started getting strong jobs report after strong jobs report. And that really caused rates to move higher. And there was some hot inflation readings as well. This year, well, we've seen mortgage rates come down since we found out the Fed was going to cut at Jackson Hole on August 22nd by 0.3%. And you've seen mortgage rates have come down. Now, sometimes you see a little bit of a buy the rumor, sell the news. We did see rates move a little bit higher since the cut yesterday, but it was really priced in already, in my opinion. So I think this time around, hey, the Fed's projecting 2 more cuts this year. I think we'll see that happen at the October 29th and December 10th meeting. I think we'll see rates remain attractive and potentially move a little bit lower. And the jobs data we're getting today, boy, it's very, very weak. So I don't think that's going to spoil the party. But I believe that, continued rate cuts will definitely help you directly, a little bit at least, with some of the construction loans, but also will help the demand side of things because, consumers seeing low sixes, that's definitely sparking some demand already.
Yeah, I would just add a couple of points on that because it was all well and good in terms of what their current thinking is. But when there's a neutral or assumed neutral level of the federal funds rate, which is somewhere around 3%. So the federal funds rate is at a level today that it's restrictive. It's restraining economic activity. So even after this cut, the Fed still has a restrictive policy in place. And they should have a restrictive policy in place because inflation is too high. And my contention is that that the messaging is really going to matter. If they don't put out the right message when they're cutting interest rates, long-term interest rates might rise, and they need to do everything in their power to avoid that happening, because housing is a huge driver for the broader economy, and it's dead in the water right now. And that has traditionally been one of the best transmissions mechanisms for monetary policies, the way that lower interest rates help the economy. And if you cut rates and cut short rates and long rates go up, it's really self-defeating. So I think that the last thing I'll say on it is I think they can do more, accomplish more by doing less. And if they cut less than the markets currently think, I think it'll anchor long-term rates close to where they are right now.
Danushka, do you have any thoughts on this?
That's what we're expecting too. There is a dual mandate. I think the labor market won over the inflation this time around. In our forecast, we have just one more rate cut in December, priced in for our forecast, like 25 basis points, and then about another 2 for next year. So, the Fed fund rate long term, we think is going to be higher than it was historically was.
Mm-hmm. And what do you see, Alex? Go ahead.
Yeah, I would say we're kind of in the same boat. I mean, we look at what the Fed is doing, but we also care greatly about mortgage rates. We don't directly forecast mortgage rates, but we do look closely at what the bond market is implying the trajectory of mortgage rates will be over the next several years. And right now, the bond market really isn't calling for significant relief in long-term rates. I think that's tied into long-term inflation expectations. It's tied to debt issuance, right? So at least as far as we're looking at housing right now, we're not seeing a ton of relief, or we're not expecting a ton of relief coming from that mortgage rate channel. Um, I think if we get to a point where the economy really is slowing and the Fed is trying to juice housing, is trying to use that mortgage channel to juice the economy, then maybe we could see that change. The Fed has been, I think the mortgage market also is not always the greatest at predicting what's going to happen. I think the Fed's dot plot changes all the time, and as it should with new data that comes in. And that's their projections over what they think is going to happen over the next couple of years with Fed funds rate, inflation, GDP, all that good stuff. Um, but yeah, we're not expecting a ton of relief on the mortgage rate side right now. I think it's a tricky moment for the Fed right now too. I mean, they just came out of a time where we think back to when inflation started to rise. They were pointing at the inflation, calling it transitory. A little bit late to the punch on raising rates. Now we're in a situation where, all right, they're looking at tariffs, they're looking at the potential inflationary impact from that, but they don't want to make the same mistake again of calling that transitory, of calling it a one-time price increase, and losing credibility on uh, any potential increases in inflation that we do see. So it's a tricky spot for the Fed, but I do think that you're going to see them be reactive to changes in to changes in jobs in particular, but they won't be forgetting changes in inflation as well.
Right. Well, and you did mention the price increases. I just saw an article talking about tariffs, and we'll get to that later, but if real quickly, you can touch on that because they did talk about price increases from tariffs only going to be a one-time deal. Is that, how are you guys looking at that at John Burns?
Yeah, so we're looking at this closely. We've seen some evidence that you were seeing it if you break down that inflation number, you can look at core goods prices, right? Core goods prices are inflating again. That's a change from recent history, right? You've seen over the last, really call it 10 years or more, goods prices have been net deflationary. They've been pushing down on that overall inflation rate. You saw that change during COVID, a lot of the supply chain issues, inflation, increasing prices on goods. Then we got back into deflationary territory again for a little bit. Now we're in inflationary territory for core goods in the near term. The big question for us, I think, is whether or not that is sticky, right? I think there's two elements there. There's number one, is this a one-time price increase? That's what we've seen in the past with, in past rounds of tariffs that have been much more narrowly focused. We've seen a one-time price increase that hasn't led to a lot of inflation. But this time it's more broad-based. And then also, I think the challenge is this could be a one-time price increase that plays out over the course of 12 months or more, right? As we see different deals get negotiated, as we see changes to trade policy, et cetera, right? I do think that puts the Fed in a tricky spot right now for gauging the impact of tariffs on inflation. The other big piece that I'll just touch on quickly too is it's going to depend on consumer demand, right? Whether or not these prices can be passed down to consumers in the end. And we're seeing that may not be the case this time. During COVID, of course, there was a lot of stimulus. Consumers were flush with cash. This time, not as much, right? Consumer spending is slowing. Consumer credit's a little bit more stretched. So I think that's going to limit the ability of some of these price increases to translate into increases on the consumer price side.
Right. It's almost like they're having to split it a little bit, right?
Yeah, I mean, we're seeing exporters absorb some of the cost, and then we're also seeing some of the cost shared through the distribution line, but some of it is getting to the consumer. I mean, even Powell yesterday, he estimates that 3/10 to 4/10 of the inflation we're seeing is due to the tariffs, and that he thinks the impact's going to be short-lived. But as Alex said, one-time price increase doesn't mean all at once as these deals are being put together. I'm a little less concerned about inflation because right now the core PCE year over year, that's the one that they look at most, is 2.9. If 4/10 of it is the tariffs, which are transitory and are not long-lived, and the Fed's supposed to look through that, boy, I mean, that puts you down to 2.5%. And then there's a lot of things within these inflation reports, like owner's equivalent rent, which is imputed kind of just guesswork data. And it's way overstating how much housing services and rents are going up on a year-over-year basis compared to real-time metrics. So I actually think the Fed, if you remove some of these factors, it's a lot closer to their target than it may appear. And obviously, they have to look at the labor market. It's showing a lot of cracks. I mean, June was negative. September was 22,000. The unemployment rate, it hasn't gone up that much because you're seeing impacts from immigration on the supply side. But boy, if all of a sudden firings start to pick up, you can really start to see that unemployment rate move. And usually the labor market, it unravels fast when it does. So they need to get ahead of that. And of course, they were way late to the party in 2021. I fear that they're kind of making, well, they should have, in my opinion, cut July 30th, but now they've begun cutting. We'll see what they do going forward. But, almost making the same mistake twice because they were afraid to start cutting.
Right. Well, Chuck, let's bring you into the conversation.
Well, I think they're late to the party. And I've already written. I wrote an article about a month and a half ago, but I think they should have been a 50-point drop this time. They gotta send a message somehow. They were late to the party with inflation. They're late to the party at this point, and it should have been started about 3 or 4 months ago. And then they won't take a 50. They wouldn't take a 50. They could have done a 25, a 25, and a 25 on down, and it wouldn't have been a shock. I also think that they got to start looking at changing the mix on their balance sheet and start buying mortgage-backed securities. Maybe drop the other securities, but go after the mortgage, but strengthen the mortgage-backed securities. That'll send a message to the mortgage business. But right now, I think they're just twiddling their thumbs in what they're doing.
So Chuck, based on the builder's perspective, what are some of the things that are really important based on the decisions that were made yesterday and moving forward? What are some of the things that the builders need to take away from that meeting and really focus on?
Well, I think it might send a message to the consumer and the mortgage industry, but I don't know if it's going to be short-lived. I mean, we saw a fake back last September, October, when the Fed dropped basically 100 points on, and they faked the builders out. So the builders thought they were going to have a great selling season in the spring, and they started a whole bunch of houses. And so now we've got a huge inventory of finished houses and houses under construction. We've got about 9 months worth of inventory. So now we've got all the builders discounting like hell, trying to get rid of their spec inventories. So, I mean, the Fed has really screwed up as far as I'm concerned, and everything they've done. So I'm not a big fan of the current Fed at this point. Mark, I don't know. You and I might be disagreeing a little bit, but
Well, I don't think I think the Fed was dealt a bad hand, and I don't think they played it very well. That's so it's like it is kind of on both ends. I'm not. I mean, to me, it's one of the biggest mistakes ever was allowing inflation to take off like it did after the pandemic, and they accommodated that $7 trillion of excess spending, and we've been paying for it ever since. And there's no quick way to correct that. There's still too much money out there, and it's really weird. I meet with a lot of private equity folks, and everybody thinks that they're going to pick up these bargains because there's this wall of maturities that are coming up. But I said, but every group that I speak with, they all have a ton of money. I should raise my fee. But they all have a ton of money, and I said they can't all be smart. I mean, they can't all be the smartest guy in the room. Somebody's going to have to blink, and so I'm afraid that in that environment, the Fed's going to have to keep interest rates above their long run equilibrium. So that's why I don't think they're going to be able to cut as aggressively as people want. But the long rates will come down, and it's hard for the 10-year to get below 4%. If we have 2% growth and 2% inflation over the next 10 years, I mean, that would be all great, right? But that would mean that the 10-year Treasury has to at least be 4%. You got to give me something for the time value of money. And so I don't know how, but one of the things that has happened is that we've seen that banks after Jackson Hole, banks have aggressively been buying mortgage-backed securities, and we've seen that the spreads have tightened, and that's what's really brought mortgage rates down. That may have a little bit more room to go, and so we could see mortgage rates come down, maybe pierce the 6% level. I don't know they'll go much below that, and heavens, a mortgage rate of 6 is a deal. It is a deal. Even if home prices only rise 2 or 3% a year, it is a deal.
Mm-hmm.
If they could just stabilize where they are right now, the consumer will come back.
Yeah.
Yeah, no, I think these rates are attractive, and like you were saying, Mark, maybe some people don't know what you're talking about with mortgage spreads, but he's talking about the difference between 30-year fixed mortgage rates and the 10-year Treasury, and boy, they really did widen at one point to like 3.1%, but they've narrowed to 2.25-ish, and I think there is room, Mark, for that to come down, maybe closer to 2%. And I agree with you. I think on the low end we could see low sixes, maybe pierce under 6% a little bit, but I think that's enough to really create activity. I mean, for several years now, we've been much, much higher. People have been having life events. I think there's a lot of pent-up demand on the sidelines that would be enough to move them, so long as you're saying, Chuck, that we have a prolonged period there, and it's not like last year where it was a couple weeks and then they moved higher.
Mm-hmm.
I mean, they went right back to 7%, and it was a fake. And what happened was it faked out the builders. The builders said, okay, we're going to have a great spring season because interest rates are coming down. We've got a lot of interested consumers. So let's start building specs. My God, they built the specs.
Well, there's also this belief out there that you're never going to get somebody to give up a 4% mortgage if they've got to get something north of 6%. And I think that when you have a 5 in front of that, and what people are forgetting is a lot of these guys have 15-year fixed, and they're sitting on a bunch of equity. They're not going to be taking out as much of a mortgage, and you get a rate around there. I do think you get a little bit more movement, and it's interesting to look at that chart that shows the proportion of folks that have mortgages at certain interest rates, and you can see that the number that are below 4% is coming down quarter after quarter after quarter. You're seeing fewer of them. I have three 3% mortgages that I'm gonna hold the duration. But two of them end in 2 years. So they were 15 years that I took out after the financial crisis. So they're gonna be free and clear.
Yeah. Alex, I know that you at John Burns, you guys have done a little bit of research on what will cause some of the consumers to move. What are some of the things that you guys are seeing as far as interest rates, and what is the trigger point to get consumers to move?
Yeah, we've got a dedicated New Home Trends Institute. We have a consumer survey that we run at least every 6 months. Lately, we've been doing it every quarter. And we asked this question about what's that magic mortgage rate? What is that mortgage rate that would get you off the fence if you're an owner to, go get a mortgage for your next home if you need a mortgage for your next home. We kind of going into starting to ask that question thought that number would move down would move up over time, as people maybe got a little bit more used to the fact, all right, maybe we're in this higher for longer environment. Maybe rates are going to stay at this level for a while. We're not going back to the days of 3% or mortgages start with a 2. But we really haven't seen that for about 2 years. We've been asking this question. The magic mortgage rate, as we call it, has stayed at 5.5%. It's been remarkably consistent. And so that is kind of where we see as like, if rates go below 5%, I think that's where you get kind of this critical mass of people who, maybe you're more willing to give up that 3-4% mortgage. I think you got to remember 71% of Americans have mortgage rates below 5% right now. So I do think it's a hard sell. They got to either increase their mortgage payment a fair amount, or they got to accept less home or a less valuable home to keep their payment the same. So unless rates get below that 5.5%, there certainly will be improvement at the margin for any bit that the mortgage rates come down, I think. But I think especially for builders too, you got to think builders have been buying down rates already, right? I think it's no surprise that builders have had the most success buying down rates to a level that's 5.5% or below. That's really what we've seen over the last several years. So to the extent that mortgage rates get lower, I mean, those buy downs get less expensive for builders. But at least for the new home side, I don't know how much demand that really drives to the new home space. unless rates really get below that 5.5% range.
Yeah, but what I'm getting back from my builders is the buy downs aren't working as well as they were working 9 months ago. That the consumer, a lot of my guys are offering flex discounts. You can use it for whatever you want. And most of the time, the buyers are asking for a reduction in the sales price. Not the design center, not the mortgage. Most of them are taking it as money off the base price.
Yeah, that makes sense. I think we're seeing that too, like with builders who are discounting, right? I think for consumers right now, they see the same news articles that we're reading, right? Even if they don't have all the data in front of them, they're hearing that home prices in a lot of the country are going down. And so I think you've got a lot of consumers who are asking for those price reductions, who are coming in a little bit more savvy, and who you also have those who are sitting on the sidelines still, who are afraid to catch that falling knife, right? They see home prices going down, and rather than the FOMO period that we were in a few years ago of, all right, I need to buy now, or rates or prices are going to be 10% higher next year. Now it's, well, maybe if I wait, things are uncertain, maybe I also get a lower price.
Well, the interesting thing is that the median sales price for new homes is lower than the median sales price for existing. And we've got a ton of inventory, so the new home sales are soft. The existing home sales don't have much in the way of inventory, and they outpaced us.
Yeah,
This is a very unique situation for the industry.
Yeah, the existing homes are also heavily weighted toward if you look at the composition, they're more weighted toward the upper end. That's where we've seen growth in the South. Prior to the pandemic, sales of over 500,000 were 20% of the market. Now they're 40. So it's crazy. And so you've had all these folks moving down to the South from other parts of the country. They've got a lot of, they have a lot of equity. And so that's kind of skewed the median. I think
I would agree with that, Mark, that because the builders they're still selling houses, but they might be selling a less expensive model in their communities than they were a year ago.
Yeah, I agree with that. I like looking at appreciation numbers versus the median home price, which you guys are talking about, because that's skewed by the mix of sales. And as you mentioned, Chuck, builders could be building smaller square footage or just cheaper homes, right? So that'll pull that down. But appreciation numbers, like you said, Alex, in some markets, they're moving down a little bit. But nationwide on a year-over-year basis, according to Case-Shiller, FHFA, they're still up around 2% or so year over year. But I actually think there's the opportunity for them to accelerate a little bit more if we see rates remain low, because I do think we're going to see more demand. And there's not that much inventory out there. I mean, on the existing side, it's 1.1 million or so, but historically that's still pretty low. I know, Chuck, you were talking about how there's a lot of supply some of the bigger builders are trying to get rid of, though.
Oh, yeah. And right now they're trying to get rid of it because it's into their fiscal year.
Yeah.
So right now they're discounting like crazy.
And that leads to a question, Chuck, and I think you're going to get into this a little bit, but we had a conversation with several builders last week, and one of them is in the Sun Belt, and he was like, it's a bloodbath down here. Heavy discounting of prices where there's no thought of any kind of margin or a negative margin in some of those markets. And are you guys seeing that in certain areas, or are you seeing it blanketed across the country? From what I observed, it was mostly in the Sun Belt area, but other markets were like, oh, well, our sales are down, but
very specific.
Sorry.
It was Atlanta, and Mark is in the middle of it. But Atlanta right now is a bloodbath.
Yeah, Atlanta's economy has really weakened. It's unusual because it's a very diverse economy, but job growth there is really slowed. And the federal government was a big employer. CDC's had a lot of layoffs, and so they've had a lot of federal cuts. So much so it's actually impacting the commercial real estate because they're putting office space back on the market. It is. I think more broadly, we're just so dependent upon healthcare right now. Healthcare, and within healthcare, social services is a big chunk of the job growth. I'm in New York City today, and in New York in the last year, they've added 98,000 jobs 70,000 of that has been in social services. So it's counseling, jobs for counselors, and so the income that's associated with these jobs, with job growth, just isn't all that supportive of housing. Within the South, and actually nationally, there are a couple of standouts. Raleigh, Charlotte are of cities with 1 million or more people in them have the strongest job growth in the country, both at 2.8%, if those numbers are accurate. Charleston, which doesn't have 1 million people in it, is still booming, 4.6% job growth. Greenville's doing very well. And I'll tell you where some markets are quietly doing well is in like places like Birmingham, Little Rock, Fayetteville, Arkansas, places that are, because the affordability migration is still going on in those places. Any place that was on the hot list because it was growing really happy, that's where Huntsville was, it attracted so much building that it got overdone.
Danushka, can you share a little bit about what the NHB is seeing in this space?
Yeah, I think in the southern states for sure. I think the pandemic influx in people moving to the southern states. I think
We're not hearing her.
some of those areas.
We're not hearing you, Danushka.
Oh, I'm sorry. Can you hear me now?
Yeah, we can hear you a little bit. It's a little tinny.
Oh, okay. So some of I think the southern states had an influx in population during the pandemic. So they're, I think, more exposed to what's happening right now. But the other side, right, like the Midwestern states and like places like Boston, the New England states, people were not rushing to move to those areas. Like, I didn't really see anybody moving to like Indiana, for example, right? But I think they were able to weather that storm much better. And places like even Columbus, Ohio, has done a remarkable job of attracting population, employees. So, they are able to weather those storms better. And I think the price stability in those areas are better as well as compared to the southern states, where we are seeing price declines for housing in some areas in Texas, some in Florida. And then when you think of the housing costs, insurance has become a bigger portion of that housing cost too, especially in areas that are prone to hurricanes and wildfires. So that's something that people are considering, I think, in terms of being able to afford. It's not just the house price. Can you actually afford the housing in terms of insurance too?
Excellent. Thank you. Alex, can you share a little bit too? Because I'm sure you guys have some research to back up to add on to what Danushka was saying as well.
Yeah, I think Danushka gave a good summary. I think for us, it's really an inventory story, right? Like the inventory, both on the new and the resale side, is so much higher in some of these Sunbelt markets. Not all of them, but especially the bigger ones where you've got, especially the big production home builders who are so active and a significant chunk of market share, right? It also has to do with migration, right? I think as mortgage rates rose, you got that whole lock-in effect, right? Of, those people with those 2%, 3%, 4% mortgage rates not moving. And if you think about kind of the history of migration in this country, it's generally been from the Midwest and the Northeast to the South and West, right? There's a data point I love to look at that's the mean center of population in the country. And it's a dot that starts when we're founded at basically the middle of the East Coast, and it moves west and south every 10 years when we do the census. But I think that really paused for at least a little bit during the 22, 23, 24. The migration that was so dramatic during COVID slowed. You got those people who were, those retirees in the Midwest who said, hey, I've got a lot of equity. Now I would have to, give up my low mortgage rate to move down to Florida. So those moves those moves for migration purposes weren't happening. So you get this glut of inventory in places like, I'm in Florida, Southwest Florida. You've got a ton of inventory here from the retirees who were locked in and couldn't move down. But then you've got, those same people who are still in their houses up in the Midwest and the Northeast, who now the young family who would have moved into their house beforehand can't, right? Inventory is a lot tighter because you haven't seen that same pattern of migration that we've been used to for the past several decades. And then it got so much more dramatic during COVID. So we've seen the inventory situation. Yes, the national number doesn't look all that bad, but when you dive into the metro level data, these markets across Texas and Florida in particular, pockets of the Southeast, Southwest, even pockets of California now, you're starting to see inventory levels back to where they were, mid 2010s essentially.
Chuck, I have a question for you, because I know the builders are going to ask this question. What do we do? What do builders do? You have some builders that are in super tight markets with lots of inventory. They're trying to compete against builders that are slashing prices. And then you have other markets where, it's not really been an issue. What are some strategies that builders need to take in this kind of an environment where you have high supply, you have demand, but the demand isn't able to buy homes at that price? So what are the things builders can do in both of these situations? And how do they weather the storm?
Well, and I'll get off of just the general economics of stuff and just the dynamics of what's going on in the marketplace. Between now and December, your public builders are going to be dumping inventory. Some of them, their fiscal year ends September 30th. So right now they're hot to trot. They'll do $100,000 discounts on a $500,000 house, and they'll give the store away because they got to get rid of their inventory. Because Wall Street judges them on return on assets. Well, the best way to take care of the return on assets is to get rid of assets. So that's the game at this point. If I'm a private builder, I don't have to dance to Wall Street. So if right now you've got a bloodbath of discounting with the public's trying to get rid of inventory, maybe I don't get in the market. Maybe I don't discount to try to meet the publics at this point, because this will be over with once their fiscal year is over with. This might be a time, if I've got cash, and right now I would hoard cash like crazy if I can. If I can get rid of some inventory at a decent price and make a margin, I'll do it. And cash is king at this point, because maybe the publics are also going to want to get rid of some land inventory, some of their options or whatever they've got, again, because they're trying to reduce their assets. So it might be a time in some of these hot markets where we have a large public presence, I might be sniffing around trying to find a piece of land at this point, because they're not going to be in the land market. I can be in the land market. So there's a little bit of dynamics that's going to occur there. I would be hesitant about going out and building a whole bunch for the spring building season. I'd really watch my inventory and not get heavy. Everybody got really heavy last year. I wouldn't get heavy, even though all of a sudden it looks like mortgage rates are going to come down and it's going to be great. I'd kind of hold off on building a lot of specs at this point. I think the privates are in a good position if they want to be. If they pay attention, most of my private builders got rid of their spec inventory back in March. They saw the spring season wasn't coming, and they've been dumping. They've been doing specialty discounting and all kinds of things. And my clientele is basically 100 units to 700 units a year. It's not the little builder. But they've been strategically getting rid of their specs. The thing that they're interested right now in doing, and they've made a ton of money. They've made good margins over the last 3 or 4 years. And in talking to my builders, they said what they want to do is, as opposed to being concerned about the margin, they're concerned about their volume. And they want to hit their volume number. They're not trying to do anything else. But I talked to them about why. And they say, we want to keep our organization together. We want to keep our trades busy. We want to keep our our office staff together. And so what we're after is really having the flow of construction over a margin, because I can weather the storm, because I've made good margins for the last 2 to 3 years. I can weather the storm and keep everything together if I'm not making margins. But if I'm not building houses, I can't keep the system together. So it's very interesting what some of the builders are doing at this point.
Mhm. And Chuck, I saw an article yesterday that came out mentioning that builders should just accept lower margins. Is that something that's permanent, or do you think it's something that might be temporary,
Well,
where
you're
it's just
talking
getting
heresy.
through a season? I know,
You're
I
talking
know.
heresy as far as I'm concerned.
I agree, but I wanted to, I
I mean,
knew you wouldn't like to hear that
the
statement,
first
but it
thing I
is.
want to look at is, okay, what is the market sales price? And then I'm going to design my product back to the market sales price. What killed us in 2008 is the builders didn't change. They just kept discounting and discounting and discounting and discounting and building the same old price or same old house that they were building. And they eventually went negative because they wouldn't change. I don't think that's going to be the case this time. Builders are changing quite a bit on product. And just another piece. I wrote an article beginning of this decade that this was going to be the roaring 20s for housing. Well, COVID kind of screwed that up. And inflation kind of screwed that up. But the demand is there. We've got the two largest populations right now either coming into the housing market or in demand in the housing market. The millennials and the Z's are the two biggest markets. They're both in need of housing. Now the Z's are coming into the multifamily, and that's why multifamily is doing well. It's not the fact that people can't afford a house, so they're renting. It's the fact that I've got a gigantic population that is just getting into the housing industry. And then I've got the millennials that are right now at premium age. They've formed their families, they've had their kids. They're right now getting to the point where they're going to start moving into the big family house. And so if we could get over this, what we're going through right now, this is going to be a gigantic boom for housing. But we got to get through all this mess that was created because of COVID, because of overfueling the economy, inflation, and that. Basically, we should be doing extremely well right now as a housing industry, not in a recession the way
Chuck,
existing homes is.
Chuck, you're absolutely right. I mean, it's the inflation that's distorted things, and what that inflation did is that for everybody that earns the median income or less in America, they have just been totally wiped out because the cost of their housing, the cost of transportation, healthcare, food, it takes up all their discretionary income. They can't save. Rents have been higher, have been rising faster. So it's just been tougher for these guys to put anything away. But in places where affordable options are available, we're seeing that housing's doing okay, even in this environment. So Atlanta stinks, but if you go to Northeast Georgia, if you go to Dahlonega, kind of over then to the right, you're looking at it towards South Carolina. So Dahlonega is kind of like dead center north of Atlanta. The housing market's doing relatively well there because it's mostly the upper end. It's mostly catering to folks that make well above the median income, and the housing that's being built there is affordable. And the same things to the south of Atlanta. It's more affordable. But getting the affordability thing solved, because people don't want, most people don't want to live that far away from their jobs. Getting it solved is difficult because it's either going to have to come about. Interest rates are we're pretty much at the limit as to how much interest rates are going to solve. And we can't do it through price cuts. If we do it through price cuts, that's going to be devastating for the industry and devastating for the economy. So we really need incomes to pick up. We need the quality of job growth to improve, and we need stronger income growth, and that's going to take time.
Yeah, and the builders need to be more efficient in what they do. I mean, if they would pay attention, um, and Mark, you're totally on. We've got some builders in Birmingham, Alabama. It's boomtown. They're all doing extremely well. They don't have the public competition in there, but as much. But it's been a very good market. And my advice to the builders is do what you got to do to survive, because the market should be extremely well. You gotta weather through this, and what's going on in the economy.
Mhm.
And again, I think the Fed is just pussyfooting around. I'm, you know, uh,
Leave it
I
to
hate
Chuck
to
to
say
say
that,
what he
but
thinks.
Powell wanted to be a Volcker. Well, Volcker was strong and aggressive, and he practically killed the housing industry with what he did back in the 70s and 80s. But he was a strong personality and a strong Fed chairman. I wish Powell was a strong chairman.
I have one question, and then we're going to kind of have to wrap it up. We're at 45 minutes, so we're going to ask like one or two more questions and then work towards our closing. Thoughts on this? Are we working our way towards a recession? Are we in a recession? Do you think it's going to be a soft landing, or do you think it's going to be a crash? All kinds of questions wrapped into one.
Boy, it's very hard to tell right now. You know, you're seeing the labor market start to weaken a bit, but I mean, we just got retail sales this week, which look pretty strong. You know, obviously the impact of the tariffs is a bit unknown still, but you know, the One Big Beautiful Bill Act, you know, maybe there's some economic activity that comes from that. So it is a very clouded situation right now, but I don't see anything screaming recession at this point. But I think it's an uncertain path for sure.
Alex, what are your thoughts?
Yeah, I mean, we're pretty aligned. I mean, we've definitely got, we're looking at the same job growth number that everybody is. But I mean, we were pretty bearish on job growth coming into this year. We were calling for, sub 1% year over year payroll gains. That's not something that you typically see unless you're either going into or coming out of a recession. We didn't have a recession in our forecast. We still don't. That doesn't preclude us from getting even maybe a few more months of negative jobs prints. But we aren't super optimistic on near-term job growth. We think it's going to be kind of this slow and steady here. Something that Powell mentioned yesterday that we're paying a lot of attention to right now is it's called the break-even rate. It's like, how many jobs do you need to add to prevent the unemployment rate from going up? 6 months ago, it was probably, north of 100,000. Today, it's probably about half that. Powell even said it's somewhere between 0 to 50,000 jobs. I hope it's not 0. I hope it's on the higher end of that range. But regardless, I do think that as you look at job growth, the number that the Fed is more concerned about is the unemployment rate. And as that break-even rate gets lower, which is the result of retirement, which is the result of less immigration and less labor demand as well across the economy right now, I think that's something to pay attention to. It's much harder for the unemployment rate to rise when the break-even rate is so low for job growth. So that's really what we're looking at.
Yeah, I agree with that, but I kind of think it's foolish the way that they look at it sometimes, because what they're talking about is there's less labor demand, but there's also less labor supply, mainly because of immigration changes. And that's why the unemployment rate hasn't gone up as much. But I've never seen the break evens be negative or at low levels like we're seeing right now. And I think that's actually masking the weakness in the labor market, because, boy, you see firing start to pick up and you can see that unemployment rate rise pretty quickly. So, I think actually, I mean, the QCEW just came out recently and showed 52%. 911,000 jobs from Q1 of last year to Q1 of this year. never even happened. So, the labor market's showing some weakness now, but we're coming from a much weaker place than we thought we were before.
I agree. I mean, there's less dynamism for sure in the market, right? Like you're in this low fire, low hire environment. Quits rates are low. You're also not seeing a premium for workers who are switching jobs. That job switcher versus job stayer income rate is about the same right now. So I agree. I think you want to have more dynamism in the market, and that's not what we're seeing right now. And we don't see a ton of light at the end of the tunnel for that, at least right now.
And I think it's unique, Alex, because people are afraid of the tariff impact and also AI. I think that's starting to have a meaningful impact on people's hiring plans.
Yeah, if it's not a good sign for home sales, because if you're worried about your job, and if you're saying I'm going to stand pat, I'm just going to keep this current job and maybe kiss up to my boss now because maybe I'm thankful for the one I got. You're not moving. I mean, that's not the mindset of someone who's going to go buy a house. And so that concerns me. The other thing that I think gets lost in this break even talk is it's the quality of jobs. And it's not just the number, but so much of our job growth is taking place in healthcare. One of the things that surprised with the QCW revisions was that if you look at the ADP data, and ADP does a much larger survey, they do not show anywhere near as large a gain in healthcare jobs as what the BLS does. And I thought we were going to see a downward revision there. Maybe that's something for the next year's QCW that we're going to see. But that surprised me a little bit. And the other thing that is missing from the discussion is, I think we're near recession, even though I've got 2.3% growth in the third quarter. Atlanta Fed's 3.3. It tends to move a lot, and so, but that's generally a good ways from recession. The third quarter of 2008, the quarter that Lehman and it went belly up. Initially, GDP was reported as 2.8%. First pass on GDP growth in that quarter. Numbers get revised quite a bit. The economy may not have as much margin of error as we think it does. Certainly it doesn't if we think 50,000 is break even. But and then I guess one last thing that gets out of this discussion is the gig work, and which might be less certain with robo-taxis. But right now that's a little fail-safe for a lot of people. And I think that the Fed's, if I was to change something at the Fed, I would get rid of the unemployment rate from the summary of economic projections, because I think it doesn't mean anything. It's not, from someone who looks at it from a credit perspective, it's not a good predictor of credit trends. It stopped being one in the mid 1990s. It's not something new. First time claims for unemployment insurance are a far better predictor of credit quality than the unemployment rate is.
Danushka, what are your thoughts on, or if we're coming into a recession, and is it going to be a soft landing or turbulent?
We don't have a recession built into our forecast, but the thing is, we rely so much on the labor market data that's coming from the BLS. One thing we have to keep in mind that the response rates have come down since the pandemic. And I'm not questioning the BLS data because we all rely on that data, but the quality of that data does mean, like, do we have a, as a, like the labor market, like how bad is it right now? I think it's hard to gauge. So we're actually thinking about what does the long-term unemployment looks like. That has been the highest levels for a long time. So we are looking at all sorts of other metrics as well. But at the same time, too, we don't have a recession in the forecast. We do think it will be a soft landing, but the GDP, everything is going to be much, much lower. And for housing, we are expecting only around 950,000 single family starts, much lower than we would have liked to see. Everything is lower. We are hoping no recession, nothing crashes. That's an optimistic view here.
That's great.
It's interesting.
I wanted to say this. I wrote a piece 2 months ago, and I said, I don't think it's going to be a soft landing. I think it's going to be a touch and go. And I describe it to a lot of people as if we don't have a recession in the next couple of months, the economy is going to be okay. So the craziest things I've ever said, but because the greatest risk to the economy is right now. And it doesn't appear that we're going to have a recession right now. I think 2026 is going to be a better year. And I think by the end of 2026, when I looked at the dot plot yesterday, the dots are everywhere. They're everywhere. I mean, it's nobody really knows. My dot would be up. So I think they cut rates a total of 3 or 4 times, possibly 4, because I can't see them not cutting at the October meeting. We're going to get, when they get the September labor numbers, we're going to have all the federal jobs that fall out because it's the end of the fiscal year. And I think it's possible they raise rates by the end of next year, that they actually go up a quarter by the end of 2026. So I certainly have a rate hike in there in 2027. That's as far out as I go.
Well, we've got stimulus baked into the pie for 2026. So that's good. But I'll break the question down into a couple of pieces. Is housing in a recession? Okay. Versus the general economy. Housing has always been a leading indicator. I've been in this business for 60 years.
Yep.
Housing always has led the economy into recession and led it out of recession.
Yep, exactly.
Yeah.
We got 9 months of being in housing being in a recession.
Yeah.
I kind of agree with Mark. We're right on the teeter-totter of whether or not we're going to go into recession or we're not going to go into recession. Next year's got stimulus. That's great. Next year should be good for housing because we've got consumer stimulus in the program, and hopefully interest rates are down. But I kind of agree with the next couple of months. Where is that seesaw? And are we going to tilt over into recession or not? It might be a very short recession because of the stimulus that's baked into the pie, but we could possibly go into recession.
Yeah, I think that all the questions surrounding trade and tariffs are going to be largely behind us. Although the USMCA is up for renewal next year, I think it does get renewed. The bottom line on tariffs is that we're going to have a 15% tariff uniform across the world and a 35% tariff on anything that's made in China, regardless of where it goes. So if it goes to Canada and gets processed and sent on to the United States, it's going to face a 35% tariff. And that's kind of where we're going to be at. And that's where we're at right now. So I don't think there's any more shocks to hit the system.
I would agree.
And with fewer shocks, I think, and fewer shocks and stimulus, Trump's going to try to do everything he can so that the Republicans hold on to the slim majority that they have in the House. So he's going to pull out all the stops. And to the extent that he can do anything, he will. So I think from a public policy standpoint, we're going to have the wind at our back in 2026.
Well, the old rule of thumb of a recession is 2 consecutive quarters of negative GDP. The NBR has expanded their definition now, but the first 2 quarters, you kind of it's very muddied because the front running of the tariffs and after, but they're averaging about 1.5% growth annualized. Q3 does look like it's going to be stronger, but if things do sour, towards the end of the year here, it's funny, you won't know if we're actually in a recession usually till at least 6 months later.
Yeah.
Yeah, the NBR never did have the two consecutive quarters of decline. We're the only country in the world that doesn't use that definition, but we've never used that definition. But I will tell you this, because we talked about employment a lot. It's extremely rare to have 2 months of declines in non-farm and payrolls and not be in recession. And typically, even if there's small declines, because when we got the December data in January of 2008, non-farm employment declined by 11,000. I believe that the January data was a decline of 17,000. So neither decline was very large, but every economist said that we were in recession by mid-February of 2008. It was unanimous. And we didn't see a negative GDP print until they revised the numbers in October of 2008 till they did the annual revisions.
Yep. Well, I want to thank you all for this spirited conversation. I love all of your different perspectives and how you've contributed. As we close, I'd love to hear, there's two questions. You can choose to answer one or both. So in closing, tell me what your number one thing is that you're closely monitoring right now, and or if you were a home builder, what would be your number one priority in the next 6 months?
Well,
Go ahead,
I'll
Dan.
start.
oh, go ahead, Mark.
Oh, it's
No,
good.
Dan,
I
go
said,
ahead.
it doesn't really matter. I can go ahead. It's in terms of what I am watching. I'm looking at breadth, and what recessions are. You have to have a pronounced decline that's widespread. And so I'm looking at, right now, we really don't have widespread declines, and we don't have a substantial decline. I'm actually looking for breadth the other way. I'm looking for things to start to improve. I'm looking for some broadening of good news in the economy. Because right now, one of the big reasons why we have surprisingly strong GDP growth is consumers are hanging in like they normally do. Spending rarely drops. And we're getting a big lift from AI, and we're getting a big lift from Boeing, which has kind of quietly ironed out all their problems. And aerospace output's up 15% over the last year. So that everything else is kind of stalled out, but AI and commercial aircraft are just booming right now. And that's carrying a lot of the weight. And then of course, healthcare. So we need to see things broaden a little bit. So that's what I'm looking at.
Thank you, Mark.
The main things that I'm looking at is inflation. Of course, that's important for mortgage rates, also for the consumer and the Fed's decisions, as well as the labor market. And, the labor market's been a little tricky because of this birth-death model they have that's been skewed after COVID. The revisions are huge. Also, the initial response rates have dropped significantly, but over the 3-month period the BLS gives you, it does still have about a 95% total response rate, but it's coming later, which is why you get these bigger revisions. But I think those are going to be the two main influences for the Fed, for the market, for mortgage rates. I think we're going to continue to see some weaker jobs data. I think rates are going to remain at pretty attractive levels and maybe get down towards 6%. At least that's my humble forecast. And for builders, well, I would proceed cautiously. As Chuck said, I do think we're going to see more consumer demand from lower rates and rates remaining at a little bit more, relatively speaking, attractive levels. I do think there's a chance you could see some better margins because you're going to have to do less incentives and buy downs with more demand. And also on the loan side of things for you, as the Fed cuts, I think they're going to cut 3 times this year, or so 2 more times. You will see that directly impact things like construction and land loans.
Excellent. Thanks, Dan. Alex.
Yeah, I'd echo what's been said about tracking the labor market. I think that's the number one thing to look at right now. I mean, when you talk about breadth, yes, we're getting that big lift from AI, but when you look at the impact on, information jobs are down year over year. There's other jobs that are tied to AI growth, but that's one of the key things we're trying to tease out right now. Is yes, it's great for investment, it's good for GDP growth, but we're not seeing a lot on the labor market side. And as was alluded to earlier, maybe we're seeing the impact of AI actually being a net negative on the labor market right now, as certain entry-level jobs maybe are impacted there. As far as for home builders go, I do think, one of the phrases I've heard is, stay in the mix till 26, right? Just trying to survive through what is, I think, clearly a housing recession right now. Potentially we get that upside going into 27 as well. But I think the key thing for us is, in a lot of the conversations we're having with clients is, all right, what's the good news, right? I think the good news is that pretty much everybody is long housing right now, right? We're structurally undersupplied. We talked about the demographic tailwinds for housing. There's lots of estimates out there. Our estimate is that we're about 1 to 1.5 million housing units short across the country. And I think that's a gap that's going to need to be filled to get affordability back to normal levels. So I think that's the good news from our perspective.
Thanks, Alex. Sanushka.
So aside from the big macro indicators, from NHB's perspective, I think the builder sentiment is something we are really attuned to, attention to. It came out this week, the HMI, still in negative territory, but slight optimism is that the prospective buyer traffic in the next 6 months is going up a little bit, ever so slightly. I think it's thanks to the mortgage rates slightly going down closer to 6. But that's, like Chuck said, home building, housing is a a cyclical thing along with the economy. It'll, tell us, if we are in a recession or we are getting out of that one. But that's something that we are really paying attention to.
Thank you, Danushka. And Chuck.
Thank you. Well, I'm not an economist any longer. I started out as an economist in 1968 for NAHB. I was where Danushka is now. I pay attention to all the information, secondary sources, but I pay a lot of attention to the mortgage interest rates because basically I'm interested in housing. That's my industry, and I'm not a general economist any longer. And probably what I do the most is talk to builders. I talk to them every month all around the country. What's your market doing? How are you doing? Are you doing discounting? Are you not doing discounting? And that led me back when we had the crash in 2008. Some of the builders out of Detroit and Ohio were my leading indicators. And I did a report in 2006. It was entitled, "Are We Riding a Tsunami?" And we actually started the decline in May of 2006, which the builders and the economy didn't see till 2008. And everybody thought I was nuts when I was talking about the fact that there was no market. We were selling the vapor in the operation. But by paying attention to the builders and by paying attention to what's on the ground, I was able to see this and say, okay, is this going nationwide and what's the cause of this? And I think that's important. And I agree with the fact that there's a lot of stimulus out there for 2026. I think if I could just hold on to my bootstraps and make it through this period of time, especially between September to December, when all the publics are basically dumping inventory, and come out on the other side after the first of the year, I think you're going to have a good market. But right now, everybody's feeling the pinch. And I don't know what to do about the existing home market. The existing home market is just shot. I have a chart. Born, can you put that chart up on the existing home market? Are they in a recession? Look at that poor chart. And, to balance out, they have to be at an annual sales of over 5 million. And they're in August, they were at 4 million, and in July, they were at 3.9. I mean, they got a long way to go. I feel sorry for the people that are in the existing home market inventory, but the existing home market is a leading indicator for new home sales. So I look at this and I say, okay, what is this telling me for the home builders? Well, what happened was we built and we ended up with a huge inventory. So enough of the chart. It's depressing.
Yeah, I describe it as locked out and locked in. That's basically the problem with the existing market. I mean, you got owners that are locked in, and you've got everybody else who's locked out. And I don't know. There's not an easy solution. And I can tell you that in desirable neighborhoods, the houses that are in desirable school zones, the few houses that come on the market are still gobbled up real quick.
Yep. Oh, we had a house that went on the market this week at our neighborhood. Went on the market last weekend. It's already under contract. So
yeah, and that's and that's kind of another key indicator of the housing market. It's just it is an unusual period, and the level of existing home sales. I mean, we're talking about the lows of the global financial crisis. So that's not recession level. It's something a little worse.
Exactly.
Yeah. Well, I want to thank you guys all so much. We hit the hour mark. Actually a little bit over. I know Mark has got to he
I
had
gotta
a
see that on the airport.
a hard stop with us today. He's coming to us from New York. So I want to thank each of you guys for joining me today. All of your contribution to this conversation was invaluable. My hope for all of our builders is that you got a lot out of our conversation today, that you're able to take something today and make an impact on your business. It's so valuable. What you do is important for the American dream. You guys build homes for people to live life in, and it's important for you to remember that you're not building boxes. You guys are building homes where people celebrate life. They celebrate life, marriages, births, graduations, Christmases, Thanksgiving, every holiday under the sun. They're experiencing that in those homes. And so I'm hoping that you can take what we talked about today and add value to your business so you can continue doing what you're doing and making an impact on the American people. So with that, I want to thank you so much. And we look forward to seeing you at our next Builder of Choice Insights podcast. Thank you, everybody, for being with me today.
Bye, everybody.
Bye. Thanks, guys.